My name's Jim Fearon, and I'm Vice President for Hayes in Central Canada, and I'm also responsible for our oil and gas business in North America. I'm going to spend somewhere around probably 45 minutes today sharing a brief sort of, I guess, high-level overview of the results from our latest salary survey. If you do have any questions at all throughout the survey, please do send them through on the chat function, as April said. I'd also hasten to add that really the conclusions or some of the insights that we draw from the data that we see are our own, and we format them based on, or we form them based on what we see in the industry and all the work that we do on a day-to-day basis, and from the salary guide results themselves. And it's very possible that you could have different insights and see things very differently. And as April said, we're very, very interested in hearing how you may be interpreting some of the things that we're talking about. So please also feel free to give us that stuff. So I'm going to start off just by giving you a brief overview of Hayes. I appreciate that some of you will have a reasonably good understanding of who we are. But I'll take a moment just to introduce you to the firm a bit more. So Hayes is a leading global staffing and recruitment company. We're publicly traded on the London Stock Exchange, and last year our turnover was more than $5.3 billion, US dollars that is. We operate 20 specialist divisions around the world, including oil and gas, accounting and finance, construction and property, HR, IT, office professionals and procurement. Our core service offering is the provision of permanent, temporary and contract recruitment services. But in addition, we're also a managed services provider, and we have a raft of clients around the world that outsource their recruitment processes and contractor management to us. And we provide technology platforms that make those processes more efficient and effective. We currently employ a little over 8,000 staff in 33 countries around the world, and last year we placed just over 47,000 people into permanent roles and around 210,000 people into temporary or contract assignments. We put this guide together with a partner called oilandgasjobsearch.com. They're one of the industry's leading job sites, and their database contains over 1 million industry professionals and is a great source of candidates. And if you haven't visited their website before, we'd recommend that you do as a useful tool. I'm going to give you a brief overview of the survey, or background to the survey as well. So our aim with this guide is to provide our clients and candidates alike with useful information that assists them in dealing with the global nature of the oil and gas industry, so that when a client looks to ramp up a project in a new location around the world, they may have some sort of reference point to what local hires in a variety of disciplines might get paid, and the benefits packages they may have to offer to get them there, and typically what they may have to offer expats as well to move them to that location. At the same time, it can provide candidates looking to move around the world with similar information and guide their expectations depending on their intended destinations. When we started out on this exercise, we actually discovered that it's a lot easier said than done because of the complexity of the industry, but now that we're into the 5th publication, we're really proud of what it's become and the amount of engagement that we have with it. We're keen to try and make it as useful as possible to people as we can, and are certainly open to feedback on ways that we might improve it. So again, feel free to suggest anything. This year we had a record number of respondents with just over 45,000 completing the survey. They covered 25 technical disciplines across 188 countries, and more than 10,000 of them are also employers. So we feel this gives us a really strong cross-section of the overall market. A quick look at the demographics of the respondents this year. So just below 10% of all the respondents were actually female, which was an increase of 6.5% year on year. 1/3 of them were expats working on overseas assignments, or you could say 60% of them were, sorry, not 1/3, 40%, 60% of them were locals, and then about 65% of them are currently in permanent jobs versus about 35% being contractors. There are some small changes in the year-on-year figures here, but it's pretty much the same. And I'd say that it is encouraging to see that there's an increasing number of females responding to the survey, and we think that's a good indication of a slight change in the market. I'm going to go on a bit of a globe trot around the world and give you an overview of what we've seen in the various markets this year. I'm going to start with a bit of a general overview of the global market. So I will also take this moment to point out that the survey was conducted in October prior to the oil price descending to its current level. So the concerns and uncertainty that this has created around the globe won't necessarily be reflected, especially around projected hiring trends and the market outlook and salaries. That said, we survey people about far more than just salaries and hiring plans, and given the oil price will recover at some stage in the future, whether that's in the shorter or the longer term, we don't know, but it will. And so plenty of the findings are still very relevant and topical, and I hope you'll find that as we talk through them. So firstly, to give you the overview, 2014 was a bit of a roller coaster ride. What started the year as a mild concern in certain regions regarding the health of the industry turned into a rapid downward slide in the last quarter. Demand for oil weakened due to geopolitical and economic turmoil, and coupled with surging production from shale oil in the US and rebounding production in Libya and Iraq, left the world's markets awash with oil. So the oil price reacted correspondingly and rapidly dropped to levels not seen since 2009. What impact this will have on salaries and pay rates around the world is yet to be seen, although it's highly likely to result in downward pressure in most locations. But what we saw in 2014 was a slight bounce in average salaries from around the world, with a slight dip from a slight dip in 2013. After taking into account the changes in demographics of the respondents and the fluctuations in currency exchanges, it really translated into an increase of about 1.3% to the level of 82,200. The average salary of local hires was $71,600, and that of expats was $99,000, and the average contract day rate was $540 per day. So now moving on to North America, where the US has continued to become a dominant oil producer globally. It's left other producing nations, most notably OPEC, figuring out what to do to absorb this output. Advancements in their technology has seen production in the US soar by over 3 million barrels per day since 2011, exceeding 8 million barrels per day this year, largely due to surging production from unconventional sources, particularly shale. So their production levels reached a 28-year high in 2014, and US imports fell from 45% in 2011 to 26%. In Canada, activity initially saw a rebound on the strength of the oil price. However, the continued delay of any major pipeline projects prevented any major increases in production, with the vast majority of operators focusing on production optimization. The LNG market is gathering more momentum, with more than 90 projects at some stage of development through the region. We saw a number of those projects stall towards the end of the year. However, plenty are still progressing through the development cycle, and it looks like they could provide some welcome activity for the industry in 2015. They'll also create some significant recruitment headaches, as talent with relevant experiences in short supply in the region. The average permanent salary across the region was $117,500, some $35,000 above the global average, and local and expat salaries are near to parity. Moving to Latin America. Latin and South America are experiencing increasing interest as changes in legislation and expectations of strong economic growth will potentially create opportunities for investment. In order to reverse its decade-long decline in production, Mexico aims to attract as much as $50 billion in foreign capital by 2018, as well as the talent it lacks to develop its deep water and unconventional resources. If its round one auction scheduled for 2014 goes ahead, it will see over 150 onshore and offshore blocks auctioned off. Argentina, like Mexico, has also moved toward a more open market and has started to overhaul its energy regulations and improve its incentives to lure foreign investors. The country is cash-strapped, but its shale reserves could make it energy sufficient for decades if it can attract the capital and skills it currently lacks. Brazil is reconsidering its policies implemented in 2010. Investors have been losing interest in this market due to its energy policies, rising costs and increasing business risk. In addition, the government's decision to halt a decade of annual auctions in 2008 continues to mean that growth of the market has stagnated with the lack of a predictable auction schedule. That said, Brazil still dominates the subsea segment of South America, and it's expected that as much as $90 billion will be spent on subsea projects through to 2020. In Venezuela, PDVSA is struggling with its post-Chavez nationalistic policies. The cash-starved state-owned company may be forced to sell further international assets in order to raise cash and to potentially prevent asset seizures by international companies. Venezuela is currently petitioning OPEC pretty hard to cut production and to help its ailing economy. You can see here that the average permanent salary is just above the global average, and expats can expect salary levels in line with North America. Moving on to the UK and Europe. So other than Scottish independence being decided, which I think is a good thing myself, little has changed in terms of the ageing assets in the UK North Sea. Most companies have adopted a wait-and-see attitude before they make further investments as they await implementation of the recommendations from the Wood Review. Deloitte released a paper recently that indicated it's almost 5 times more expensive to produce a barrel of oil in the North Sea than it was in the late 1990s. However, there's new tax breaks for brownfield projects which could spur increased interest if we see an upturn in the price per barrel. North Sea oil companies made their lowest profits in 5 years during the first quarter of 2014, and companies on both sides of the North Sea are cutting investment programs focusing on cash flow and preparing for potentially turbulent times ahead. Investments in Norway are expected to drop at least 30% this year based on $50 barrel prices. Seismic companies have seen their market soften as the appetite for exploratory investments has diminished, and offshore drillers have witnessed rig rates fall sharply as companies have cut capital spending. For onshore UK and Europe, the jury is still out on whether unconventional drilling will gather momentum. In the UK, new legislation is making it easier for companies to drill horizontally under residential dwellings, but there's not surprisingly significant lobbying and opposition that will possibly make any significant advances impossible. Moving on to Russia and the CIS. Russia relies heavily on oil and gas related duties and tax, and the political tensions between Russia and Ukraine have been partially responsible for the current global economic uncertainties. The US and EU sanctions against Russia has had a huge impact on their ability to trade, devaluing the ruble massively in the last quarter of last year. There are a raft of Arctic and shale projects worth billions of dollars waiting to go ahead there, but the withdrawal of Western investment skills and expertise makes it highly likely that we'll see any progress there anytime soon. In the Middle East is split, with Saudi Arabia, Kuwait and the UAE experiencing continued investment both on greenfield and brownfield projects. There are conflicting reports as to the break-even points for the Middle Eastern oil plays, with reports claiming anything from $18 to $40 per barrel. Saudi Arabia, the leading member of OPEC, has continually stated that it will not cut production in order to bolster oil prices, and is happy to allow market forces to dictate the price. However, they're coming under a lot of pressure from other OPEC members that rely more heavily on revenues from oil production, where their production costs are far higher per barrel. So hopefully that will have an impact. Iraq is destabilized by continued militant activities. Importantly, these disruptions have yet to impact their southern oil fields, but there's continued and real risk that militant activities will spread to parts of the region and could create major disruptions in the production and transport of crude and associated products. Currently, there's more than $234 billion worth of engineering, procurement and construction contracts being awarded on oil, gas and petrochemical schemes in the Middle East region's energy sector, exhibiting an unexpected surge in project activity in the past couple of years. There's also around $963 billion worth of EPC projects planned or under execution in MENA, oil and gas related industries. So hiring activity remains buoyant in the Middle East. Looking at the disparity of local and expat salaries in the region, it's no surprise there's been a surge of initiatives by local governments and companies to increase the local labour content of the workforce, but they've really seen limited success, and NOCs in the region continue to develop global recruitment strategies to attract the estimated 100,000 engineers that they're going to require over the next 5 years. Moving on to Africa, Africa is expected to hold a 15% share of all offshore capital expenditure during 2015, and that's up 10% on last year. This is led by developments in offshore Angola, Ghana and Congo. According to a recent report by the International Energy Agency published in late 2014, almost 30% of global oil and gas discoveries have been made over the last 5 years were in sub-Saharan Africa, which reflects a growing global appetite for African resources. Deep water skills are still in demand, mainly in reservoir and drilling engineering, but there's an increased need for LNG, process engineering, naval architecture and subsea engineering skills after significant gas finds in Mozambique and Tanzania. Governments in the region have also been implementing initiatives to attract nationals back to their home countries and training schemes to entice locals to join the industry. And although certain countries have tightened the visa requirements for foreign workers, the region will certainly be heavily reliant on expat workers in the short and medium term. Progressing towards the southeast corner of the globe, so in Asia, Singapore has grown to be a significant Asian energy hub, and energy now accounts for about 5% of the country's GDP. With Singapore's first LNG terminal now fully operational and entering into its phase 3 expansion, we wait to see if the Singapore government will push through its stated intention to position Singapore as a hub for LNG activities in the region and targeting LNG bunkering operations by 2015. A more traditional stronghold for the Singapore market, though, has been the expertise and proven track record in the design and construction of offshore production facilities, including rigs, FPSOs, FSOs and topsides. Singapore is currently responsible for a massive 75% of the world's FPSOs currently under construction. In China, activity levels have been modestly up, but the coming development of unconventional gas will lead to an increase and redeployment of capital expenditures. During 2014, Asia's EPCs and shipyards saw significant contracts being awarded to the region due to increased confidence in their ability to deliver quality services, particularly in Korea. A majority of these contracts are in feed or construction phases. Consequently, we've seen an increase in demand for skilled project engineers and construction professionals there. And then finally landing down under, Australia's has 60 million tonnes per annum of additional LNG capacity coming online and is poised to become the world's largest LNG producing nation. That said, most of their projects have seen severe cost overruns and delays, and consequently the underlying economics of the projects are now questionable. Their financial viability will depend on continuing to secure high prices from Asian importers who may be lured away by cheaper exports from North America. This has put a lid on new LNG projects and has shifted attention to improve the economics and efficiency of existing operations. The existing LNG projects are not yet in need of large numbers of skilled professionals in operations and maintenance. However, when this does happen, from mid-2015 onwards, a large shift in the industry's workforce will occur as workers with the design and construction skills needed to create facilities are replaced by those required for ongoing operations and maintenance. Australia continues to pay the highest local and expat salary, although the levels have dropped somewhat in the last 12 months. And that's the end of the review around the world of the market overviews. I'm going to go into a bit more detail around the key findings from the survey specific to Canada and North America as a whole. So I was going to start first off with a brief look at the salaries. Again, I think that based on what happened with the oil price, maybe these are less relevant, but I think it's worth touching on them. So you can see here that the average salary in Canada was $116,500, which is a drop of about 8%, but it's still around about $35,000 above the global average. You can see that there's been pretty significant decreases in average salary for both local and expat hires. Personally, I was quite surprised by the year-on-year drop in local salaries. I think there's a couple of things impacting this. Firstly, it's been a relatively flat market for the last couple of years in Canada, and so I think that's had downward pressure on salaries, although there have been some busy parts of the market. Secondly, I'd say that it's possibly been exaggerated by a change in the demographics of the Canadian respondents to the survey this year. So possibly more people at junior levels responding to the survey, and as a result, that's shown a reduction in the salaries. Interestingly, Canada is the only country in the survey that pay higher salaries to local workers than they do expats. And furthermore, Canada also employed fewer expats when compared to other major economies. And we'll look into why that might be a little bit later on. So looking at how these salaries compared more broadly throughout the Americas, we can see here that there's a huge disparity in some countries between expat and local hires, whilst the US and Canada are very similar in that there is very little difference between the salaries between the two. Whilst in Mexico, Brazil and Colombia, you can see a significant disparity, with expats receiving an uplift of as much as 30% on local levels, and really that's down to the fact that the expats come from areas of higher socio-economic strength. Before I go further into the survey, into the findings, I thought that it might be useful to look at what the employers who responded to the survey saw as their main concerns for the year ahead, with the exception of 2010, where largely the Deep Horizon event meant that environmental and health and safety concerns was at the forefront of CEOs' minds. The skills shortage has been the main concern for oil and gas business leaders over the last 5 years, and it continued to be in 2014, and for the year ahead, despite concerns over the economic outlook. To get a better understanding of this concern, we also asked what people thought the major contributing factors are to the skills shortage, and in Canada we saw that poor knowledge transfer, a loss of manpower mainly due to the pending retirement bubble, and the lack of fresh talent entering the market as the top 3 issues. Interestingly, we saw almost identical results from our friends south of the border in the US. We always like to have a look at the mobility of the workforce, in essence, where people are travelling to and from for opportunities. We've also included some information in here on what drives their decision making, how people are looking for jobs, and in turn, how employers are actually trying to find them. So firstly, to look at how we import talent, you can see here that companies in North America as a whole have a smaller percentage of employees that are expat workers, way below the global average, with only 30% of respondents being expats in Canada, and you can see in the US the figure is even lower with 20%. There's also a 3-year declining trend that's very clearly pronounced in North America. There are a few possible factors at play here. Globally, I think there's been a ramp down in major project work, particularly in Australia, where the raft of LNG projects that have been underway have either reached or are nearing completion. And so we're seeing a lot of that talent moving back to its country of origin. More locally, the fact that our markets here are fairly unique. In Canada, it's obviously very oil sands and focused, and the US and Canada has a big focus on non-conventional plays, and there's far less talent around the world with skills that meet the demands of our markets. Plus, there are far greater immigration barriers to bring talent into both Canada and the US, making the import of talent a far less feasible way to deal with the skills shortage. Certainly in Canada, immigration laws are getting tougher and tougher, as it feels like every month. So I think we'll see this a continuing trend. So next, we want to have a look at where in the world Canada goes looking for talent. And so we can see here in the #1 spot is India, with 16% of the expat workforce being imported from India. In #2 spot is the UK with 9%. Then in 3rd spot is Iran with 7%. The Philippines is next with 6%, and then Pakistan is in 5th spot with 5%. I think the fact that the vast majority of expats moving to the Canadian market come from lower socioeconomic regions is probably the reason why expat salaries are slightly lower here than they are in other countries and other regions around the world. This year, 16% of employers believe they're going to need to increase the number of expat workers in their organisation. I think there's a good chance that a high percentage of those will be focused on the LNG market. Interesting, only 2% of the respondents with experience in LNG globally were based in Canada, whilst 19% of them were in Australia. So as mentioned before, given that most of the LNG projects are nearing completion in Australia, it has to be a target market for the Canadian LNG projects to go hunting in. And so let's have a look at the reverse and where Canadians typically travel to. So the top 5, not surprisingly, I think, is the US with 13%. Next you have Saudi Arabia with 11%. The UAE, which has moved slightly, is at 8%, and then you have joint on 5%, Iraq and Qatar. So Canada has one of the lowest percentage of its talent working on international projects when compared to other regions, particularly Europe and Asia, where the figure is closer to 40% rather than the 15% that we see here. The survey highlighted that a massive 86% of Canadians working overseas will consider a return home for their next role, and that company reputation will be the most important thing for them when they look at making that move. So there's clearly an opportunity for employers here if they work out how to tap into this returning expat workforce, especially if they can do it whilst they're passively thinking about it and not actively in the market. Following on from that, we wanted to drill down further into what guides an oil and gas job seekers' decision-making process. So we asked them exactly that, and the results of all the respondents around the world were as follows. So the number one thing was salary level. So 95% of respondents said that salary level was a number one driver. Then in a very, very close second spot, and there's only 3% in this, so essentially it's equally as important, was company reputation. And anecdotally, we've seen this becoming more and more important for candidates in all industries around the world, and particularly in Canada. The third most important thing with 88% was benefits, and then in fourth spot, and again it's a very, very close fourth spot, so it's basically equally as important, was career progression, and this is also something that we're seeing becoming increasingly important. Now, we also asked the Canadian employers that responded to the survey what they're doing to be more competitive with their offerings, and we saw that 25% of employers altered their pay structures in 2014 to be more competitive, which was just ahead of the global average of 24%. We've also seen an increase, but a relatively small increase, a number of companies putting together an employer value proposition and then wrestling with the challenge of how to communicate it to their target market. It's certainly something that many of the larger companies are further down the track on, and I'm sure many of you, like me, may have sat in the reception of one of the majors or super majors and seen employee testimonial videos, amongst other things, up on big screens as they work hard to sell their EVP. And then 7% of employers have tried to make their benefits packages more attractive this year, and this again is something that's been increasing year on year. And we're going to look at benefits in more detail on a later slide. And then finally, 31% of Canadian employers have made improvements to their training and development programs, although when looked at in conjunction with some of the other statistics later on, it might be better put that only 31% of companies have done this. So we've also looked at what job seekers are looking. So we've just looked at what job seekers are looking for from their future employers, but we also thought it would be equally interesting to look at actually how they look for their next jobs, and so that's what the information on this slide shows. So no real surprises to see that company websites is the highest with nearly 50%, and this is global averages. And just a point on this, given how this is clearly a strong candidate attraction tool for organisations, it's very important to make sure that the careers section of your website is kept up to date with your latest vacancies and other relevant information. And this is obvious, I know, but you'd be surprised how often it doesn't happen. But you also have to think about how people are using the internet these days. We found from other studies that we've done that more and more job seekers are using mobile technology to look for jobs, yet only around 40% of employers' websites are mobile friendly. So you need to be making it easy as easy as possible for people to apply for your jobs. And in the world of convenience that we live in, if things are too hard, then often people simply won't bother. And that means you potentially lose out on good candidates. Next, you see recruitment agencies with nearly 45%, followed by job boards and networking with about 30%. And then finally, bringing up the rear is social media with just under 25%. I'm going to take a moment here to talk a bit more about social media as a digital recruitment tool. So you can see here that 22.7% of job seekers use social media to search for jobs, and that nearly 70% of oil and gas professionals use social media for personal use. Yet when we asked employers whether they currently use social media as part of their candidate attraction strategy, only 3% said they did. Now again, this is a global figure, and I'd suggest that in Canada employers track above this figure quite considerably, but it's definitely no more than 25% of them that are actively engaged in the use of social media as a candidate attraction strategy. And this is a huge disparity, and one that is only going to grow. As a global recruitment firm, we're seeing social media being used more and more by job seekers and employers alike, and it's a fantastic way to engage both active and possibly more importantly passive job seekers. It presents a great channel to communicate your EVP to a captive audience and get your message heard. Now, I'm going to follow on this topic briefly, and by way of an example, at Hays we've invested a huge amount of time and money in developing our social media following and network. One of the key mediums we focus on is LinkedIn, and in the last 4 years we've managed to grow our following from around 300,000 to more than 900,000, and we're now the 21st most followed company on LinkedIn, and recently we've overtaken some of these well-known brands on that particular league table. As part of our strategy, we've also developed a number of specialist forums. One of them is an oil and gas forum that we now have more than 45,000 members as part of, and they're active, and we're actively engaged with them, and they communicate with us on a regular basis. Importantly, the people that follow us on LinkedIn and in our forums do so for no other reason than they choose to, and so it's them that's engaging with us, not necessarily the other way around. Now I'm sure it doesn't sound like it, but I'm not just trying to show off here, and there is a point. And that point is that as a result of this engagement, our followers are 6 times more likely to view a role that we post, they're 3 times more likely to apply to it, and they're also 10 times more likely to refer our content to their network. And this gives us a far greater reach to even more engaged candidates that are likely to be interested in what actually could be your job. So I'd argue that being referred by one professional to another professional is one of the most powerful ways to do recruitment. There's a couple of messages here. One is to choose your recruitment partners wisely, and I'm tongue-in-cheek there a little bit, but not entirely. And the other is that the recruitment landscape is changing rapidly, and to be effective, companies need to be developing their recruitment strategy to ensure they're as visible as possible to their target market, which means being present where they're looking. And that's a challenge for everyone. I'm going to come on and look at a few recruitment challenges and some of the retention strategies that people are using, particularly around benefits, training and development. So firstly, to look at benefits. As we saw earlier, benefits is very important to employees. So we asked whether people are receiving benefits and what sort of benefits they receive. Some really good news for Canada, for Canadian oil and gas professionals here. So in 2014, we saw a 7% increase in the number of companies offering benefits, with almost 70% of employees now receiving them. This is the highest number in 6 years of conducting the survey. So although in the last 3 years, Canada has actually fallen behind the global average. This shows that companies are clearly see it as a strategic importance to offer a strong benefits package, and that it's actually expected by their employees. Not surprisingly, health plans are the most offered benefits, with bonuses coming in second, although RRSPs are very close behind in third place. You can also see there that almost a quarter of employees receive training as part of their benefits package. Again, that's a good thing, but again, you could also argue that only a quarter receive training as part of their package. And when you take this into context with some of the other data we're going to have a look at in a minute. And so, because we've been asking these same questions year after year, we can actually have a look at historic changes and trends in how benefits have changed. These are the global averages. Averages are not specific to Canada, and you can see that all areas have been increasing year on year. Bonuses have really leveled out in the last few years, but all the others have seen major increases in the last year. Training has received the biggest year-on-year increase at more than 50% increase, and now over 21% of companies are offering some sort of training and development. This means Canadian companies are ahead of the global average in the amount of training that they offer. Next, we're going to come on and look at a couple of hot topics of discussion in demographics. One of them, gender. Gender's been on the issue in the industry for a long time, and it's a big concern for employers over the years. We've been involved in a couple of big campaigns with global organisations around gender diversity, and it's something really that we've seen little change around the world. And there's also a well-publicised concern over the ageing workforce that's progressing towards a retirement bubble and a relative lack of entrance into the industry. So let's have a look at what we've seen on those topics. And so gender's first, and I'd say this is a pretty encouraging looking graph. There's a slight increase globally over the last few years, but for Canada, you can see some significant increases. So to be clear here, 21% of respondents to our survey from Canada were female. That's 118% more than the global average. I appreciate that doesn't necessarily mean that 21% of the workforce is female, but it's definitely a very positive trend, and Canada is clearly achieving some outcomes that the rest of the world are struggling to. The highest percentage of women are employed in oilfield services. Actually, we see a huge volume of them working in business development type roles, but you can also see there's a good spread across other disciplines, and 34% of them are actually working in contract roles, which is actually very similar to the volume of men working in contract roles as well. Coming on to the age demographics, and again we've been tracking this every year that we've run the survey, and now obviously given the size of our sample data, we can get some variations to the results, but typically we've seen results that look very, very similar to this year in, year out, and the pending retirement bubble is clearly demonstrated on this slide. So the dark blue there is the global results, which actually looks pretty healthy, a pretty healthy spread, and Canada is the light blue bars there, and there's clearly a pronounced problem. I think there's comfort to be taken from the fact that it's even worse, it's an even more pronounced problem for the US, but this year 37% of our Canadian respondents were aged over 50 or over, and indeed 54% were aged over 45, whilst only 19% are Gen Y. The deep technical knowledge and expertise sits with the baby boomers, so really there's a 5 to 15 year window, to try and transfer this knowledge and replace the talent that will be departing the industry. It's a complex problem. The current market conditions add an additional issue, not necessarily to do with the loss of existing talent, as I don't really think companies are going to consider losing their best and brightest, but another deep down cycle so close to the last one could make the attraction of fresh talent into the industry even harder, whilst other technologies-based markets become more attractive. On top of that, the rest of the Canadian economy is looking far more positive about the outlook for the next year or so. And there's going to be a wider choice of opportunities available to people entering industry from schooling, and so oil and gas is going to be competing with a lot more, a much stiffer competition. Certainly, companies need to be spending a lot of time developing robust succession plans that include comprehensive training and development programs in line with the needs of their businesses, and they need to be thinking about how they're going to attract increasing volumes of fresh talent and what mediums they're going to be able to engage with this talent through. Lastly, and I'm going to touch on this very, very briefly, we're going to look at some of the hiring trends and outlooks for the year ahead that we saw pre the oil price fall. I'm not going to spend too much time on this. So looking back to October, employers were pretty optimistic about the market conditions. Though in Canada only 54% of them had plans to increase permanent headcount, and I think this demonstrates a degree of caution about the market, and it was clearly well-placed caution. How much of an impact the oil price will have, we'll see, and it will certainly be interesting to look back on 2015 in a year's time and to have a look, but I think there's going to be downwards pressure on hiring plans, and there's going to be downwards pressure on salaries. Moving on to look at the contractor workforce, and there's been a declining trend in the use of contractors over the last 3 or 4 years. Indeed, only 36% of our respondents were contractors, and last year we saw an 18% decline in the use of contractors in North America. But 84% of Canadian employers are or were expecting to see contractor numbers hold steady or decline in the coming year, and I don't actually think there's any surprises here. This huge change is a clear response to the challenges around co-employment and the investigations that the CRA has been launching into the industry, and I think it's simply a response to that. And so then briefly to run over the key findings again. So more employers are offering benefits than ever before, and health plans are on the rise. Company reputation is equally as important to future employees as salary level. The skills shortages are the #1 employer concern, and employers blame that skills shortage on the lack of knowledge transfer and effectively poor succession planning, and contractor numbers are going to be taking a sharp drop in 2015. Our recommendations, well, employers must act now really to prepare for the baby boom retirement. If we do see say a 24-month downturn in activity in the oil and gas industry, and people put hiring plans on hold in entirety, then it doesn't necessarily mean that the baby boomers are going to stop aging. And if you wait 2 years to try and solve that problem, then you just get 2 years closer to the problem. So it's an interesting challenge. You need to be targeting Gen Y to help alleviate the skills gap. You need to attract ambitious Gen Y by showcasing succession plans and training and development programs. Use social media to promote your employer brand once you've worked out what your employer brand is. Partner Gen Y with the baby boomers to make sure the essential transfer of knowledge is happening, and then look at attracting overseas Canadian talent back with a strong employer brand, because that's clearly what they're looking for. And so that concludes the presentation. I would welcome any questions at this point. Some of the questions we usually get asked, which I'll preempt, so how can we get a copy of the guide? And the answer to that is that one of our consultants will be in touch with each of you in the next 24 hours or so to organise a time to deliver you a copy. And we'll also be making this presentation available online through our website, and you can see that at hayes-oilgas.com, and it'll probably be live on there in the next 24 hours or so. So I'll just wait for a second to see if there's any questions that come through. And so I've got one question come through here. Can you give us any examples of what Canadian companies are doing to deal with the use of social media as a candidate attraction strategy? And the answer to that is quite complicated. We ran another survey last year on that topic, and we found that around about 25% of companies were using social media, albeit that they were a little bit afraid of how to use it and worried about the impact it could actually have on their brand and their ability to recruit people. And so the answer, but 70% of them were saying that they really understood that social media needs to be part of their candidate attraction strategy. And the answer is a lot of people are very confused by it. It's a very complicated topic, and it's very detailed, but largely it comes down to finding a way to engage with prospective candidates outside of just talking to them about jobs. The challenge with that is that typically when companies are using their social media network, it's to sell their products or their services as opposed to trying to engage with prospective employees. So the answer is you have to somehow get some content out of them that gets them interested and gets them following you and communicating with you that's relevant. We feel that we've developed quite a large amount of expertise on the topic, and we would be more than happy to come and talk to people more specifically about that in the near future if you wanted us to. But it's a very difficult question to answer succinctly and quickly, I'm afraid. It looks like that's the only question that's coming through. So I'm going to end the presentation here. Thank you very much for tuning in and listening, and I look forward to speaking to some of you again in the future. Thank you very much.